Θα ήθελα να παρακαλέσω τον κύριο Δημήτρη Στρατικόπουλο, ο οποίος είναι ο Διευθύνων Σύμβουλος και Head of M&A Central and Eastern Europe της Deutsche Bank, ένας από τους ανθρώπους οι οποίοι είναι πίσω από πάρα πολλά από τα επιχειρηματικά deals τα οποία γνωρίζουμε στην Ελλάδα, αλλά πολύ παραπάνω ελέγχει τις ομάδες της Deutsche Bank σε όλη την Νοτιοανατολική Ευρώπη. Έχει κρίσιμα στοιχεία, τα οποία πιστεύω θα μας βοηθήσουν να καταλάβουμε λίγο πιο πολύ για το τι γίνεται σήμερα στο τραπεζικό σύστημα και πού οδηγούμεθα.
Κυρίες και κύριοι συνέδροι, εκ μέρους της Deutsche Bank, σας ευχαριστώ όλους και κυρίως τον κύριο Ζούνη για την πρόσκληση. Η ομιλία μου θα είναι στα αγγλικά και τα slides επίσης. Αν στις ερωταποκρίσεις κάποιος θέλει να ρωτήσει στα ελληνικά, προφανώς και μπορούμε να μιλήσουμε στα ελληνικά. Πριν γυρίσω στα αγγλικά, θα ήθελα να πω ότι από την πλευρά της Deutsche Bank είμαστε πάντοτε ευτυχείς να έχουμε την ευκαιρία να μοιραζόμαστε τις απόψεις μας για τη χώρα και την περιοχή με το ελληνικό κοινό. Για την Deutsche Bank η Ελλάδα είναι μια πολύ σημαντική αγορά. Είναι μια αγορά στην οποία έχουμε δείξει την προσοχή μας και το ενδιαφέρον μας για πάρα πολλά χρόνια και νομίζω ότι και μέσα σε αυτή την περίοδο της κρίσης παραμείναμε εδώ, ήμασταν πάντα εδώ και τώρα που σιγά-σιγά φαίνεται ότι τουλάχιστον κάποιες από τις εκφάνσεις και τις πλευρές αυτής της κρίσης αρχίζουν να υποχωρούν, νομίζω ότι θα είμαστε ακόμα πιο έντονα. And with that, I'd like to go to my presentation. There are three themes I wanted to talk about, and Mr. Ozounis asked me to talk about. First of all, to give a bit of a background on what has happened. I think that we all know, but where do we stand and what are the next steps, what we see happening in the immediate future. Second, what's the impact of the overall environment to the Greek banking sector. And on that one, I will not expand too much because a few minutes after me, my financial institution specialist colleague, William Norris, will be talking, and I think he can expand on that in much more detail and much more authority than myself. And third, and the area that's more near and dear to my heart, after all, I'm a practitioner, I live and breathe in that field, is the implications of what's been happening in the banking system to the general capital markets and M&A activity, not just in the financial institution space, but also in the real economy. And with that, if we just go a bit back on what happened. I'd say, as a first comment, that I was here 7-8 months ago addressing a very similar audience, and come to think of the situation then, my main sentiment right now is one of relief. Back then, 8 months ago, the foundations of the system were in question. Nobody could make any projections for what was to happen in the next month or two. It was just a month and a half after Lehman going bust. And I think that over the last 6-7 months, we have clearly weathered pretty well the phase 2 of the crisis. It's not over yet, but I think that the foundations of the model are not questioned anymore. Yes, there are going to be tweaks, but the foundations are there and relatively intact. And I think just to be more aligned with the overall theme of the conference, it seems that the governments did do an at least adequate job overall in averting the systemic crisis. Now we are getting to the third phase of the crisis, which is a prolonged global recession. A recession is always a bad thing. The recession has casualties, but we've been through recessions before. We have all seen recessions. It's not nice, but we know how to deal with that. The systemic crisis of a year ago, we hadn't seen it, not even in the 30s. So indeed, there are challenges for the banks in the current environment, but we are getting in more of the known territory. We have weathered the completely unknown part. Generally, for a banking sector to be stable, you expect three things. To be functioning properly, you need access to funding, you need healthy capital, and you need proper asset quality. When the crisis started, it started on the funding side in the UK and the US. I remind you, Northern Rock, Bear Stearns. We then get into issues of capital inadequacy, the financings on the UK banking system. RBS comes to mind. And these two parts seem to have worked reasonably well. Now, the third area, asset quality, is the area that we still need to see what's going to happen. There is an unknown on asset quality. We all read about stress tests. We have a stress test in Greece yesterday. This is still not clear. It's true that, runs on the banks have been now completely avoided. That was the issues with the funding. With regard to the capital, the governments have actually done an okay job, at least okay job, recapitalizing the systems in the Anglo-Saxon world, partially in countries like Greece, Austria, and Italy as well. Germany, not to be forgotten. But asset quality, the verdict is still out. I think these are issues you all know. On asset quality, as you see, right now, our best scenario is that we will get to the deterioration we saw in the previous recession in October 2002. Worst scenario talks about asset quality deterioration that will be something like 30–40% worse than that. Again, this is something that the system should be able to deal with, but it's not going to be nice, it's not going to be pleasant. Funding post-Lehman is coming back to a reasonable rate. We are not in the go-go years, we are not in January 2007 where money was practically free in terms of cost, but at least we are getting into more normal situations. And then with regard to capital, I think it's a clear shift. We think this is structural. We're not coming back soon to higher Tier 1 ratios. We think that the Tier 1 ratios by 2010 for the banking system are going to be above 10%. The investor base is going to change. There will be more focus on core capital. We have seen some massive rights issues already. I think we've seen 18 billion out of HSBC, 12 billion pounds out of RBS. We saw a big rights issue out of NBG a few days ago. We expect that we will see significant activity on the rights issue area in the next few months, and it will be to get to those levels. Now, as I said, there is relief, but there should be no complacency. For an economic recovery, there are a few bog standard boxes that we need to tick. I'll just read a couple of those. Well-capitalized banking sector, certainty of valuation with regard to assets, availability of credit to businesses, access to credit, etc. I'd say out of these 7 key metrics, we are not ticking any right now. We are, for the first couple, 2 or 3, we are now in a position to see the light at the end of the tunnel, but we are not there yet. So recovery is, a number of quarters away. The government, as I said before, has done a generally good job in averting the systemic crisis. I think on the liquidity and funding front, that has clearly happened. On disclosure, there's been very significant pressure for this to be improved. I think we see it happening. On capital injections, we've seen recapitalizations in a number of systems in the Anglo-Saxon world, but also closer to home. Private capital is still reluctant to get into the banking sector, apart from very global champions and some national champions. We've seen private capital coming into HSBC, which is one of the global leaders, to Santander, which is the proxy for the Latin-speaking banking, if you like. Swedbank happened, NBG will happen, but it's not something that's easy for the Me Too bank, the number 3 or number 4 bank in any of those countries. It's very difficult to go out and tap the equity markets for significant amounts of money. I think on sector consolidation, we've seen a number of domestic mergers. I would say the vast majority of them were defensive. It was governments like in the UK bailing out HBOS, and then HBOS together with Lloyds or Northern Rock. We've seen this in Portugal. We've seen this in Belgium, in Denmark. I'd say, and William Nours, my colleague, who has actually advised the Treasury and the French government, I would say that the only merger of that nature that we've seen and has actually worked well without creating embarrassments was the one in France, Banque Populaire and Caisse d'Epargne. The others left a lot to be desired. Obviously, they were transactions that had to happen to bail out the systems, but they have not been particularly successful to date. With regard to distressed assets, good bank, bad bank, discussions are happening in a number of countries. There are some countries that have done it in the past, know how to do it, but still the concept is controversial in a number of jurisdictions. I would say that based on where we stand right now, the longer-term outlook for the banking sector, again, not catastrophic, but we are not out of the woods. And clearly, it's a completely different ball game moving forward. Capital and liquidity requirements are increasing. Shift to core tier 1 is going to be the name of the game for the next few quarters. We will see this in the capital markets, in equity capital markets in particular. Regulatory focus will be, and scrutiny will be definitely intensifying. Reduced scale and complexity of banks, that we'll also see. And that doesn't only hold true for banks, also holds true for insurance companies and financial conglomerates. Behemoths like AIG have a fundamentally very strong insurance business, and then they were run down because of obscure capital market operations out of a 100 square meter office in London. Importantly, we see, and that's something we at Deutsche Bank see quite clearly, reduced cross-border banking. When you have a government bailing a bank out with taxpayers' money, I guess it's only reasonable to expect that the politicians will ask all these resources to be primarily used within the national borders. That's why it was extremely important for us as Deutsche Bank and for some of our major competitors, particularly in the US, either not to accept any government money or in inevitable situations like the ones we've seen in the US, to try and repay this as much as possible and as quickly as possible, because otherwise, a global business model is not going to work. We are one of the few that we were careful or determined enough not to accept any such government intervention, and that meant that we were open for business across the world throughout the very testing times. And then the institutionalization of the non-banking sector is important for two reasons. One, because they can take up part of the black box complexity we had in the banking system before, because as we said, regulators will expect the the banks now to be much more simple organizations, at least the ones that have direct government exposure into them. And two, because particularly hedge funds have been part of the problem with regard to short selling and other aggressive tactics that it seems that the system is not prepared to accept anymore. Impact on the Greek banking sector. A few things, because as I said, my colleague is going to spend much more time on that, and then on one of the panel discussions. The key issue for us in Greece is the open question mark on the quality of assets. We do not have full clarity of how the stress tests worked in Greece, but we have a sense that the next 3-4 months are going to be quite important to understand how bad a bad scenario in Greece will be. I think we need to see how the tourism is going to behave. We have to see how much of a rebound we'll have in shipping. These are areas of very significant exposure of the Greek banking system, and also these are areas that impact quite a bit disposable income in Greece and the Greek consumer. On capital adequacy and funding, I would say that at first blush, the Greek system is in a much better position than many other countries, the systems of many other countries. And overall, we would think that if Greece plays its cards well, it could actually end up with a strengthened position in the Balkans at this juncture, because some of our natural competitors in the area are in a much worse situation. Tier 1 capitals, Greece is around 10%. That, I think, includes also the NBG rights issue. But, and that's an important point I've raised before, versus the Italians and the Austrians, who are a real competition in the Balkans. Greek banks look much healthier. And in terms of where the growth for the Greek banking system and the overall Greek economic growth is, we believe that's going to be in the Balkans. The Balkans clearly were not a safe haven, as some people thought in the end of 2007 or early 2008. Clearly, it was the first time that these economies were tested in really rough waters. We think they are coming out reasonably okay. Once they are out, we expect that their growth projection is going to be much stronger than one in Greece and Western Europe. And the people that would have stayed the course would be able to benefit significantly. The sense we have is that Central Eastern Europe, banking inclusive, post this crisis will reemerge stronger. With regard to funding, as I said, things are moving back to normal. They are not going back to the nirvana of 2007, but going back to levels that people and capable institutions can deal with. Asset quality, William will spend more time on that. The exposure to Southeastern Europe is in the minds of investors. This is the front where clarity and better communication, and actually being able to see what exactly happens in the next few months will actually dictate to a large extent how well the Greek banks are going to do and how their valuations are going to evolve. And to get to the more practical aspects of what all this means in terms of capital markets activities, in Greece and in Europe, there are a few things I wanted to share with you. First of all, valuations in Greece have corrected much more than in Western Europe, and almost in line, slightly less than in the Balkans. That has to do with the amount of hot money that hedge fund money, really, out of London and offshore areas that was in the Greek market. So as soon as the crisis started, all these people had to go and deal with fires closer to home. So they sold first, asked questions later. I think, apart from that, and that was a technical reason, there are also concerns that as credit is becoming tighter in the region, one, the banks, who are a very significant part of the Greek market, are not going to have the growth and thus the value that people were projecting back in 06 or 07. And in addition to that, they feel that growth overall in Greece is not going to be as pronounced in the next few years as before. Now, if you were to focus on the green bar, this is the expected growth for 11 to 15. So these are normalized years. The view Global Insights gives us, but we also see that quite a bit in discussions with investors, they think, okay, Greece is going to be growing something like 2.3% versus an EU 15 of 2.1. So broadly in line with the core of the European Union. When the big run in the Greek equities happened, 04, 05, up to end of 07, Greece was the safe proxy for Eastern Europe. Yes, that was a system that you could understand. People that wanted to play Balkans, they would play it safely in Greece, but Greece had, at that stage, growth rates that were roughly double, or a bit less than double, the ones of the core EU. Right now, that doesn't exist. And that's why I said before, in our mind, it's quite important to be there in the Balkans, because the Balkans, Yugoslavia, ex-Yugoslavia, Serbia, for example, is growing like 3 times what Greece is supposed to be growing in 11, 15. Bulgaria, Romania, again, double the rates of Greece. So that's why we feel that these areas are going to be very interesting, and the people that will be able to stay the course will reap the dividends. As we said before, foreign investors left Greece to fix things closer at home. And now the other thing we see is that during this crisis, it does pay to be Greek to deal with Greek issues. For example, in shipping, there were some challenging situations that worked out relatively well at the end. There were some restructurings that happened well. I guess right now on Neochimiki, there is the rumor out there, it's more than a rumor, I guess, that the international private equity that came in with having no Greek understanding at all will, trying to restructure and renegotiate, getting back in, the people that knew how to deal with this whole situation. And overall, we think that because we've seen some leverage buyouts in the last 3-4 years in Greece, our view is that if an investor does not have a Greek angle, they cannot really come and do successful investments in Greece. Greece looks Western and is Western in many aspects, but it's not that Western yet. You need to understand local color to be able to actually do it properly. I think going to the equity markets, our projections right now, based on announced pipelines, is that this could be the biggest equity year ever. Last 6 months have been extremely strong. They're primarily driven by rights issues, 1, from the financial sector, 2, from winner-take-all situations. So you see the biggest player, I don't know, in metals and mining or in energy, going out, doing massive rights issue, preparing for more acquisitions. So I think in the last 6 months, we've seen 100 billion in Europe of capital raising. We think that the market this year will be at least similar to the one of 07, which was the top market ever. We see quite a bit of activity in convertible bonds. Actually, an interesting example was ArcelorMittal. They did 2 convertible bonds within 4 months. The only difference in these 4 months was that the coupon in the second bond was 200 basis points less than the first one. No other terms changed. That shows that investors are coming back in. We have net inflows to the capital, to equity accounts, because bonds are not competitive anymore with regard to yields or other investments. And as I said, there is significant stock selection. It's winner takes all across the board right now. So the very big players that have done very well will continue doing so and attracting capital. The middle-of-the-road situations, maybe once there is more clarity and comfort in the market, we'll be able to tap it. But there will be quite a lot of unfinanceable situations that back in 6 and 7 could actually raise money with not too much trouble, right now are unbankable. Leverage finance is also coming back, in no way near the way the equity markets are coming back, but in the last 3-4 months, there are a number of high-yield issues. I think Pernod Ricard did 800 million euros. Again, these are not new leverage buyouts. These are high-yield issuers that have a solid business model and are coming back to tap the markets. But again, the LBO market it seems to be warming up again. And M&A, which was the area that withstood 07 and 08 better than all other products, is slightly below last year, but we are at the levels of 05, 04, 05, which were pretty decent years. They were not the exuberant years of 6 and 7, but they were pretty decent. With regard to where we see M&A, what type of M&A we see strategic deals, winner takes all in all industries, except financial institutions. Financial institutions, we see more inward-looking transactions. We don't see cross-border anymore. We see significant distress selling. Regionalization, as I said, particularly in the banking system. Leverage buyouts, the high-yield market is coming back, but we do not see as much as we saw in the 04, 07 period. And what we started seeing quite a bit in Greece as well is public to privates. I think we have now 2 or 3 public to privates in Greece. One is reasonably sizable, is Alpha Vita Vasilopoulos by Deleuze. I think Imako is also being taken out. And if I'm not mistaken, also Grigoris was taken out. Some of those are relatively small deals, but I think the trend is here, and we'll see it increasing in the next few months. What we haven't seen yet, and we expect to see it as soon as the credit markets are a bit more robust, we will see hostiles. We haven't seen hostiles yet, but we've started seeing people, particularly outside Greece, building stakes in the capital of weakened corporates. Watch that space. We think we'll see quite a bit in the next couple of quarters. On sectors, and now try to operationalize it a little bit more in Greece. On financial institutions, we think that we're not going to see international deals, but we'll see local deals. In Greece, there are 4 or 5 smaller entities that are clearly earmarked for sale. They're all elusive major transactions that would really transform the Greek picture. Has not arrived yet. I wouldn't rule it out, but it's difficult to also be certain that it will come. Insurance, I think, across Europe is an area where we'll see transactions. We were about to see a number of drastic transactions in Greece, but I think it was just the timing of the crisis that made a number of parties pulling this. Energy, as you know, the Greek government is selling DEPA right now. We see that in energy overall, we see a number of transactions across the board. This is a hot sector. Industrials, we see quite a bit of activity, but this is distressed activity. As you know, 2/3 of Detroit are now bankrupt, and that has also implications in Europe. Deals in industrials, as I said, will be more opportunistic and vulture fund type. And then financial sponsors have eclipsed to a large extent. If anything, we see significant distress in their portfolios. In the UK, two of the listed ones, Candover and 3i, had to go to rights issues just to fund themselves. So we do not see that much financial sponsor activity coming into Greece. And as I said before, the view we have is that whatever private equity activity we'll see in Greece will have a very clear Greek angle. That could be Marfin Investment Group that has done the majority of public to privates in Greece anyway, or other new players, but we do not see, three guys out of London running numbers on a corporate and coming in Greece to execute a public to private. I think with that, I wanted to thank you for your time. Mr. Zounis, I think we could be open for a few questions. And just if I were to leave you with a message, is that it seems that we have avoided the systemic breakdown, but we are not out of the woods. Continuing to act with humility and prudence would be good advice. And although we haven't seen the bottom of the corporate market, we do believe that there is a number of very significant opportunities that will arise for the corporates and the banks that will be well prepared. Thank you.
My name is Plato Monokrousos. I work with EFG Eurobank as an economist. First of all, thank you very much for the very interesting presentation. You mentioned that according to your projection and estimates, the Central Eastern European region is going to exhibit a much faster growth, GDP growth, than in Greece, once the global financial crisis is over. The question is the following. Growth in countries like Bulgaria, Romania, Hungary, Ukraine, and Poland has been mainly domestic demand driven, so driven by credit, not export driven, and also driven by very strong capital inflows channeled to the domestic real estate markets. So we're talking about the same model of growth as in Greece. Also, this year and the next, those countries will suffer a significant contraction in real GDP growth. The question is, where do you see the competitive advantages of those economies going forward? And I would like to elaborate a bit on your view that those countries, or several of those countries, will exhibit faster growth than Greece.
First of all, I'm not an economist, but as a practitioner, I'll tell you what we see and how. I wouldn't necessarily expand, the numbers to countries like Hungary or Ukraine. But what we do see is that particularly in countries like Romania, there is a lot of FDIs, foreign direct investment. These are industrial assets that have been built historically, and they continue to work, and we continue to see quite a lot of interest for investments. There is a clear question mark because these governments had never dealt with this type of crisis before. And I would say at least the first few quarters of the crisis, their response had been underwhelming. But with regard to where, somebody, a corporate development department, strategizing in Frankfurt or in Paris, countries like Romania and Serbia are in their minds. Romania, because it already has a very significant capital base and, a number of very positive aspects. Serbia, because effectively, they have really missed the previous train of the late 90s. And with regard to the industrial base or the ability to develop one, the sense we have, And from the discussions we have with a number of Western clients, they seem comfortable with that. I think it's true that, for example, Romania did exhibit an asset bubble, a real estate bubble, I mean, no doubt. But our analysis and our views is not driven by the correction on that. We think, and when I talked about numbers, I talked about numbers after 11, assuming that by that level, that time, things have stabilized. The volatility in 9 and 10 in these countries, I would definitely agree with you, will be much more pronounced versus Greece. But we think that normalization in 11 would deliver this type of growth again there because of their asset base, the quality of the asset base, the ability to attract foreign investment. And as I said, the biggest area for us is Serbia, who have to play catch up versus the rest. And even now that we speak, there are like 3 or 4 major M&A processes happening in the Czech Republic, where people want to buy industrial assets in the $500 million type of size.